Well, here we are, a day after this Federal Reserve policy announcement, and the markets are interestingly circumspect. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we find is that the markets are strangely unconvinced, having generally celebrated what sounded like a Fed that was a little bit more dovish relative to forecasts. A bit of a struggle here to make headway and a bit of a struggle to pointedly unravel. Markets seemingly searching for direction. But we did have some very interesting developments outside the Fed here that are noteworthy and should be looked at to kind of fill out our understanding of what's going on in these markets and why, now that this event risk is off the board, the markets might be feeling a bit unsure of themselves rather than just hitting the green light to further gains. And so, with that, we are going to take a look a little bit backward at what has been going on in these markets, not only since the Fed announcement, but also a little bit earlier. And then what is then coming immediately in front of us into the end of the week. So the question really, while you were focused on the Fed, and of course myself as well, what else happened? Because there has been an interesting set of the developments that's played out in parallel. The first comes to us via an updated set of PMI numbers. And if we look at the US, it's an interesting story. And what we find is that manufacturing is, for the first time in a while, growing a little bit faster than services. And the overall economy seems to be generally in solid shape and growing at a relatively analog rate across sectors. So if we look at how this came out for March relative to expectations, of course, this is, as ever, in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So what you find here is relatively interesting. So you have in December the start of a run up in manufacturing that takes you out of contraction territory now to positive growth. At the same time, services starts getting a little bit more sluggish. You can see the orange line there running behind the dark composite line. That's, of course, because services tends to be the major driver for the composite. It's a much bigger contributor to U.S. economic growth than is manufacturing. Services about 3/4 of the economy, about 70 odd percent. Manufacturing is closer to 20 odd percent, and the rest is agriculture. So when you look at it here, what you find is that pickup in manufacturing is being pushed against, when we look at the aggregate, by a slowing service sector. And so what you end up with is a sort of standstill. So growth clearly deteriorating through the Fed's rate hiking cycle across the board, then finding a bottom, recovering last year, finding a peak in around the middle of last year, and then settling into a kind of idling range. Interestingly, that's despite the seeming tailwind from lower borrowing costs, as the markets have been moving to bake in Fed rate cuts and front running that and bringing yields lower. So, at least relative to where they were when the Fed stopped raising rates. So, what we have here now is an interesting sort of standstill where the economy is not really shrinking, but it's also not really accelerating. It's a similar story in the Eurozone. Here, the divergence is in favor of services. Services attempting to pick up steam here, actually returning to growth and registering faster results than expected, 51.1 versus 50.5. The manufacturing side, though, is pushing the other way. It's shrinking at a faster rate than expected, 45.7 versus 47. And what that's done to the composite index is helpfully lifted it to basically standstill. Nominally 49.9 is the ninth consecutive month of contraction, but it's close enough to standstill that we're pretty much there. But standstill is hardly something to celebrate. And so it seems like, once again, we're kind of anchoring at a worryingly anemic level. Now, a reason to be concerned about this, even as the markets don't show sign of immediate credit stress, is that if you take the US and the Eurozone together, they account for 34% of global GDP. And this is actually an understatement because the third biggest component, or the third big component, second largest, is China at 16%. And it, along with the rest of world 50%, are greatly dependent on demand from the US and the Eurozone because that's the end of the global supply chain. That's where the rich consumers that buy everybody else's stuff are located. And so we've seen, of course, in spades that China has really been unable to get back on its feet, having reopened from zero COVID restrictions, largely because it was so late to reopening that its main end demand markets, the US and the Eurozone, had to adjust supply chains. And of course, they had no shortage of incentive to do that as the geopolitics between China and the Western powers got a little bit more testy. And so we've had a kind of loss of market share, and China hasn't really been able to return to any kind of pre-pandemic glory that people thought it might be able to achieve if only those zero COVID restrictions were to go away. That goes in spades for the rest of world 50%. Largely, these are vendor economies that depend on exporting to rich world consumers, or at the very least, exporting to middle of the supply chain economies, notably, of course, China, that then gives you value-added work to finish or semi-finish, at least push forward toward the finish, whatever inputs arrive there, again, with the idea that it's going to service demand in the US and Western Europe. And so if you have growth idling in the US and the Eurozone, even though, of course, in the US, it's very much still positive, it's just not accelerating. Whereas in the Eurozone, it's almost standstill, having been shrinking. These are not necessarily bad outcomes as far as direction. But if these things are not making any progress forward, it's already a big concern because they are together at surface level a third of global GDP. But their influence on China and on the rest of world economies that service that demand is even more outsized. And so with them, global growth is idling. And existing levels. This is, of course, a concern because not only are we looking at a growth cycle that needs to be powering a recovery at a time when interest rates have increased considerably, but if you were to see anemic growth at a time that global debt continues to hit records, then debt to GDP ratios will start to rebound. Since 2021, one kind of positive of runaway inflation has been to dilute debt burdens. Because when you take into account inflation, relative GDP to debt calculations have become a little bit more favorable, even as global debt by the end of 2023 at a record high $310 trillion across both public and private sector debt. You have a situation then where there is the risk that managing the pile will become harder. Now, of course, rising interest rates are themselves a concern. S&P Global estimates that about a third of this pile is attached to floating rates. So servicing this debt is already an issue, even if you don't have to think about the debt coming due and rolling over. But it is coming due, of course, not all of it, but a large chunk of it is coming due. The average maturity on this is somewhere in the vicinity of 4 to 5 years. And we are, of course, about 2 years removed from the start of a blistering rate hike cycle that has made servicing this debt much more expensive. So redemptions, in addition to managing the floating rate debt, is already a kind of significant background risk. But on top of this, if growth is anemic, then the debt to GDP ratio starts to rise again. And if that's how this moves, well, then the burden of servicing that debt is ever harder. If you generate lots and lots of economic growth and you have current income that's improving, that is, your debt to GDP ratio is falling, or at the very least receding, because although debt is growing, GDP is growing faster. Seeing the reverse of that dynamic, or at the very least an anchoring of that dynamic, if growth stalls at current momentum while debt continues to increase, and at 313 trillion in the fourth quarter, according to IIF, it's not a negligible pace of increase. For reference, it was 307 in the third quarter. So if we look at how much of a change there's been, the economy globally added more than 5.5 trillion in new public and private sector debt in the fourth quarter of 2023 alone, which is a vast amount. So if growth doesn't necessarily shrink, but just stalls at about the slow growth rate that the PMIs suggest, while debt keeps going up, servicing that debt is going to become that much harder. More and more income will have to go toward debt servicing. Less and less of it will be actual economic growth. And of course, on top of the higher rates, that makes for credit risk. Now, the markets are not responding to that just yet, but the alarm bells ought to be starting to ring here if this continues to go this way. Then there was the Bank of England. We talked about the situation in detail on macro money yesterday. And if we look at the PMI numbers, just as an aside, they also came out for the UK. Here we saw slower growth than expected, the composite a little bit lighter than expected. And again, in this case, a US-like divergence where services has been cooling and manufacturing is attempting to return to growth. Not quite there yet, but again, just on the cusp of that 50 line, and growth in some, once you take both of those into account, seeming to anchor once again at a relatively soggy level. But that wasn't the main story overnight. It was the Bank of England striking a dovish tone, as we expected, incidentally, when we discussed this on Macro Money yesterday. You can see here the stock of expected rate cuts for 2024 as baked into interest rate futures increasing here out to 69 basis points. Perhaps most tellingly, the voting tally on the MPC, the Monetary Policy Committee in the UK, losing all of its hawks. So it's a 9-member committee, and they vote on a one policymaker, one vote basis. So it's a strict majority rule kind of a decision. For example, if Governor Andrew Bailey were to be in the minority, he could get overruled. The way that we were going into this meeting, we had one call for cutting rates, 2 calls for hiking rates, and the remaining 6 policymakers calling for no action. The expectation was that after CPI came in a bit soggy this week, with the recent declines in job openings, with the slowing of wages, the Bank of England might be getting closer to easing, and they would signal as much. And so at least one policymaker from the hawk camp would defect and go into the no change bucket. As it happened, both of the hawks packed it in. There were no votes for rate hikes in this outing for the Bank of England. Instead, what we got was one lonely dove, as before, calling for a cut, and everybody else going into neutral. And the British pound did not miss what this was implying. So we got this increase in the stock of expected stimulus. The timeline also seemed to shift. So ahead of the meeting, the expectation was the cut was going to happen in August, rather. Now, what we find is that it is much more likely, not all the way baked in, but much more likely to occur as soon as June. So we can see here that 20 basis points out of the 25 needed for a cut are there. So that's an 80% probability that the first rate cut is already on deck by June. We then see that by September, there's a second, and by December, there's a third. So the markets at this point at a more dovish setting, and of course, as we've just alluded, the pound responds accordingly. We were talking on Macro Money yesterday as the pound retested this resistance following what the markets initially interpreted as a dovish Fed, popping here to retest former support, become resistance at around the 128 figure, and thinking maybe a dovish Bank of England would mark a reversal, and did it ever. Sharp rejection at exactly this level, heading back down in the direction of the 126 figure, which if we can take out this support area, call it just above 126, 126.20 to 30 or so, looking at where these wicks and closes are, we might open the door for this larger support right around the 125 mark. And finally, ahead of us, Japanese inflation. That was another major central bank announcement this week. The Bank of Japan pointedly delivering on almost a year and a half of speculation, suggesting that the move away from negative rates was coming, that the move away from yield curve control was coming, and that's exactly what occurred. And so what we found was indeed the Bank of Japan moved rates back to zero, so issued a 10 basis point cut to go from negative 10 basis points on the target rate up to zero. And the end of what had become essentially a moot policy of yield curve control, which was essentially saying there's a 0% cap on the 10-year yield with some thresholds around it to allow the yield to oscillate. And what we've seen is that there was some pressure on this as the Fed was raising rates, forcing the Bank of Japan to widen the acceptable band of volatility around this yield cap. And that is really what seemed to catalyze the markets to say, well, look, maybe they're getting ready to get off this policy. It's essentially showing itself to be unsustainable. But of course, since then, the Fed has stopped raising rates. So the pressure on Japanese yields to go higher largely dissipated. And so the yield curve control policy basically became moot. We talked about this earlier in the week, but the thresholds around that 0% mark going into the BOJ announcement were 1% allowed up or down, 100 basis points. Whereas the actual spread between where swaps markets thought Japanese yields should be and zero narrowed into a meager 13 basis points. So less than the initial 25 basis points that the policy allowed for before it was stressed. So for months and months, the sense has been that the Bank of Japan has a structural issue with raising inflation, but that these policies no longer were fit for purpose and could be entirely unwound. So what we ended up with earlier this week was exactly that. And because it was so widely anticipated, and the Bank of Japan signaled in its speechifying that it's not in a hurry to do anything else, the Japanese yen cratered and moved sharply lower, even though we got the hike and we got the end of this yield cap. But now we find that it curiously holds above interim support and seems to be struggling to make continued headway on the downside. At the same time that Japanese inflation is on the menu and looks like it wants to rebound. The expectation is that we are going to rise from 2.2% headline CPI in January to 3% in February. And so the question then becomes, well, might the BOJ actually look to go and tighten more? Maybe not, but there is certainly a potent reminder here that the one central bank among the majors that isn't due to cut rates this year is the BOJ. And so as you get this uptick in inflation, what you might then deliver to the markets is the stark reminder that the yen is near significant lows. Other central banks are all but anchored with where they're going next. The trajectory is toward greater easing virtually everywhere that we've heard from this week. The Fed dispelled notions that it was going to get more hawkish. The RBA in Australia and the BOE in the UK got more dovish. The one place where that didn't happen is Japan. And so perhaps what we are looking at with this inflation data is the beginning of a yen recovery if basing around these levels is what gets catalyzed going forward. And that is macro money for today. As ever, we are here right after Overtime, a show that I co-host usually with Dylan Radigan and Chris Vecchio, although we've had a nice assortment of guest hosts this week, from Thomas Westwater to Victor Jones. I am back on Futures Power Hour on Fridays, on with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money comes back next week. Take care.